Hey everyone! Welcome back to our channel. If you've ever thought about investing in startups or supporting new projects, you've likely come across the terms equity crowdfunding and debt crowdfunding. But what do they really mean, and how do they differ? Today, we're going to break it down for you in simple terms. So, grab a snack, get comfy, and let's dive in. Before we jump into the details, let me ask you this. Do you prefer owning a piece of a company or receiving regular payments for your investment? This question is at the heart of understanding equity versus debt crowdfunding. Let's start by defining equity crowdfunding. Simply put, equity crowdfunding allows individuals to invest in a company in exchange for ownership shares. This means that when you invest, you're not just giving money, you're becoming a part owner of that business. If the company does well, so do you. For example, platforms like Seed Invest and Crowdcube allow investors to buy shares in early-stage companies. If the company grows and becomes profitable, your shares could increase in value, leading to a potential financial gain when you sell them later. Now, let's look at some numbers. According to a report from the World Bank, equity crowdfunding has grown significantly over the past few years. In 2020 alone, it raised over $13 billion globally. This reflects the growing interest from investors looking to get in on the ground floor of new businesses. However, with equity comes risk. If the company fails, you could lose your entire investment, just like any stock market investment. Additionally, owning shares could mean you have a say in company decisions, depending on how much you invest and the rights associated with the shares. Now, let's move on to debt crowdfunding. This is a bit different. Instead of buying shares, you're essentially loaning money to a business or project in exchange for interest payments. You'll get your principal back after a set period, usually with added interest. Think of it as being a lender rather than an owner. Platforms like Lending Club and Funding Circle focus on debt crowdfunding. Let's say you lend $1,000 to a small business for a fixed interest rate of 8% over 3 years. Each month, you'll receive a portion of your principal back along with interest. At the end of a term, you'll have received your original $1,000 plus the interest earned. Debt crowdfunding can be seen as less risky than equity crowdfunding because you have a clearer expectation of returns, as long as the borrower can repay the loan. However, it's not without risk. If the company defaults, you might lose part or all of your investment. But typically, debt investments are secured against the company's assets, offering some level of protection. So, to summarize, with equity crowdfunding, you invest in a company for ownership and potential profit based on its success. With debt crowdfunding, you lend money for interest payments and expect to get your principal back, provided the company can repay you. Each has its own risks and rewards. Let's take a quick look at the pros and cons of each. For equity crowdfunding, the pros include the potential for high returns and being part of a company's growth. The cons are higher risk and potential loss of your investment. For debt crowdfunding, the pros are more predictable returns and lower risk, while the cons can include lower overall returns and the possibility of default. Now that you've got a clearer understanding of equity versus debt crowdfunding, which option do you think suits your investment style better? Whether you're looking to become a part owner of an innovative startup or prefer the stability of receiving interest payments, there's something for everyone in the crowdfunding world. If you found this video helpful, please give us a thumbs up and subscribe to our channel for more educational content like this. Also, drop your thoughts or questions in the comments below. We love hearing from you. Until next time, happy investing!